We're going to go ahead and begin. No delays, no nothing today. We're off to a good start. No technical issues. So thank you all for coming. Today's class is on price action. And one of the things I want to start off with today is talking about angles. Before I do that, and so we're going to be having a conversation today, at least that starts off on structure, and then we'll be getting into some frequency later on. But I want to welcome everybody here. Before I start off on the material, I want to see if there's anybody here that this is your first time in this class. First time in this class, and anybody that's new to price action as well. Because you could be your first time, but you're not new to price action, or you could be both your first time and new to price action. So Alex and Jez, okay, fantastic. Anyone else? Tim says second time here. Okay, fantastic. Welcome back. Joan as well. Okay, fantastic. All right, so I'm just going to give a brief qualifier to the statement when I'm talking about price action. The most basic definition, this is the one I like to stick with, which is it's how price moves over time. And notice that the time is not specified. Just price's movement over time is what defines price action, or how price action is really defined. But what causes price action to be what it is order flow. In other words, the buy and sell orders that are going into the market, from the retail all the way to the institutional side. And so it doesn't matter whether it is a technical or fundamental reason as to why somebody buys and sells. It just matters that they do. And how that order flow takes place is what determines the price action. Now, if you can learn how to read price action in a way where you can kind of glean the order flow behind it, then you really are getting an inside look into the market. You're not just looking at the appearance, you're looking beyond the appearance. You know, looking at price action and looking at structure only is very much like looking at the movie screen and watching a movie play and thinking the movie's a reality. If you think that is the reality, then you're not understanding what is creating that picture on the screen. We have to have the same attitude with price action, that there is something that is causing it, and that we understand what is causing that price action. And therefore, our goal as price action traders is to understand that which causes the price action we see. Because if we don't understand it, we will be in certain situations where we will just be trading what we see. We'll just be trading the structure or formations of the price action and not really understanding that there is something else going on. Something else that could be moving the market than we think it will. So, with that being said, that is the method of how I approach price action, which is to understand the order flow behind it. There are two ways that we generally, most traders, if you look at every price action trader out there, you'll find that they're all concerned with structure. And I think that's only half the view. And the other thing has to do with time, which is price's movement over time will communicate a lot of information to you about the order flow. If you're not doing that, then you will be oftentimes find yourself in positions that are very uncomfortable because the market's doing something that you didn't expect because the structure said one thing, but really the time that the market spent doing one thing or the other was communicating something else. Tim has a question right after that. Chris, what is support and resistance with you? People with memories? It's a very good question. I'm not sure if that was designed to be entertaining, serious, or a little bit of both. Support and resistance to me is useful and important, but, and I'll again describe it, but I would probably say less than 20% of my trades are based upon support and resistance. Less than that. And yet I clock in on average over 75% accurate. In fact, the last losing week I had was last week. And it's partially my fault because I was in 10-hour meetings all day and I really didn't have time to trade. And I did something that was, in my opinion, unprofessional. I consider myself to be a professional Forex trader. I manage a fund. I trade my own funds as well. And, luckily I was doing it in very light activity, but I traded when I really didn't have the time to be dedicating all my energy to that. So that was my first losing week in almost 3 months. And yet the majority of those decisions are not based on support and resistance. But support and resistance to me is very simply places where the institutional market had placed a larger amount of orders for whatever reason, technical, fundamental. It could have been nothing to do with what was on the chart. They could have just felt, you know what, this is overvalued here, or this is undervalued at this particular price. And so they buy it. Support and resistance could be based on a lot of things. From a technical standpoint, it could be based on pivot points. It could be based on Fibonacci's. It could be based on a particular moving average. It could just be based on pure price. But I don't circulate that all my decisions are based upon that. Boyke says supply and demand. It could be based on supply and demand, but it doesn't have to be. Support and resistance doesn't have to be based on supply and demand. Support and resistance could be simply, it might have nothing to do with supply and it might have nothing to do with demand. It could be very simply an institution, or I know this one guy, his name's Enzo, and he's a GAN trader. He's been doing it for 9 years now. In 2009, between 2008, when the crash happened in 2009, the guy made over 3,000%. His support and resistance was completely based upon his GAN work that he did. And yet he was able to make 3,000% and have over 93% winning trades. So support and resistance doesn't have to be based on supply and demand. In reality, support and resistance is simply a fair amount of order flow which either causes the market to stop a particular movement in one direction and reverse it in another. It could be also something that stops a current trend temporarily. Or it could be simply any particular location that the institutional market on an overwhelming scale says, we want to buy here. For whatever reason. So support and resistance is kind of has an amoebious it's kind of whimsical. It's not built upon the same material. It can be built on all kinds of different materials. And so because of that, it's very hard I don't find trading off support and resistance as something that I want to base my entire strategy off of, because of if support and resistance, let's say the support and resistance here is done on a completely different reason than here, well, the style that that support and resistance is chosen by the institutional market is obviously going to have an effect upon it. How the market responds and how the price action responds and the order flow responds when price hits that support or resistance level. So because the underpinnings behind support and resistance are whimsical and have quite a variant nature, I don't spend a whole lot of time trying to figure out support and resistance. How many times has price come up to a major support and resistance level and blown right through it? How many times have you experienced that? Probably the whole time. So I don't base all my trading off of that. I don't make that the underpinning of all my trading. There is a couple things I would like to say about that, which is that there's two things. There's about two or three things I like to say about it, which is support and resistance becomes powerful when the price action that's leading up to that support and resistance demonstrates, hey, we're going to respect this or we're going to react off of it. But price action could be coming up to a support or resistance level and have no respect for it whatsoever. In fact, let's just say somewhere on the chart here, this was a support level. I'm not saying it was, I'm just drawing out some random line. And the market came up to it, and you were thinking of buying here. It's a round number, it's a support resistance level, whatever. You're thinking of buying here, but then you look at this and you see, wait a minute, candles are getting bigger as they go into that. This is why I don't necessarily base my trading off support and resistance, because if the price action leading up to it says we're going to smash right through this, then the support and resistance is completely irrelevant. Support and resistance only becomes meaningful when the price action leading up to it communicates that we are going to respect or react to the support or resistance level. But if every single candle for 5 candles in a row is getting bigger, bigger, and bigger and bigger, well then what does that tell you about the order flow? It tells you that the order flow is not just heavy selling pressure, but that the volume and the number of orders to the downside is increasing. The only way you can actually increase the size of your candles in one particular direction, in this case the downside, is if either A, the amount of money going into the short side is increasing, B, the amount of orders going into the short side is increasing, or C, both. Those are the only 3 environments that you could create that kind of price action. And so, if you were to see that kind of price action, and it's communicating to you, wow, increase in order flow, volume, volatility, everything like that, well then the support and resistance is meaningless. So that's why I don't make support and resistance the mainstay or the holy grail. That's why I like to use price action as something that I think far trumps support and resistance only. That's why I like to, and it's mostly because when I look at price action, I don't look at it just like everybody else does in structure. I understand that price action is a product of order flow, and that's really what I'm trying to understand. And when I understand that kind of price action structure that I was talking about with the increase in candles, I understand the order flow behind it, and when I understand that kind of order flow behind it, I'm thinking, now I know what the market's going to do. So that's my thoughts on that, Tim. Hopefully that answers your question. I got a couple other questions here, 3 more, and then I'd like to get into today's chart so I can get into today's subject as well. This is an excellent, excellent start, though, to the discussion where we're going here today. So next question is, how much time should one spend in front of the monitor? What do you recommend? This is a tricky question in the sense of it would depend on where you are at in your trading. if you are consistently profitable, whether it's 10% a year or 40% a year, well then I wouldn't spend too much time in front of the monitor. I would only spend the amount of time that is absolutely required. Because the bottom line is you are not paid by how many hours you sit in front of the monitor. You're paid by how much you make per trade. Most people out there think money is the most important resource or commodity. But the bottom line is that anybody who has some sort of money and understands the nature of money doesn't think money's the most important resource. They think time's the most important resource. Why? Because time is not renewable. Once it's gone, it's gone. Money is renewable. Case in point, Donald Trump. Once a billionaire, went down 900 plus million in the hole, came back to being a billionaire again. Anybody ever been flat broke? And then all of a sudden had a bunch of money some point later down the line, or more money than they had before? I have. Why? Because money's renewable. I can always make money back, but I can't make more time. So if you are a consistently profitable trader, then the answer would be the absolute minimum you need to keep trading the way you trade. In fact, if anything, I would be spending a little bit more time away from the charts if you're already a consistently profitable trader, and spend more time analyzing your actual trading. Not analyzing charts in real time, but analyzing your actual trading to see where the leaks and holes are. So you can start to really learn from that. If, on the other hand, you're not a consistently profitable trader, well then I would recommend it kind of a two-prong approach. I would recommend spending a little bit of time in front of the charts, but spending more time studying, finding a particular edge, system, something that you gravitate towards, and then spend your time learning that as much as possible. That may or may not require time in front of your monitor. And then once you understand that, I would spend time employing that as much as possible until you have effectively learned that system inside and out, and then go try it out. Give it a shot. If you already have a system, but you're not profitable and you're trying to learn how to make it profitable, I would spend a fair amount of time analyzing, but I would spend as many hours as you can in front of the monitor, and here's why. There's a book called Outliers where they talk about the 10,000 hour rule, but it actually came from a study that was done by, his name is Anders, I forget, it's a Swedish guy, I think. And he did this study where that people that had studied a particular thing for 10,000 hours had assimilated so much data. Erickson. There it is, Pip Shaker. Thank you for reminding me. So, had assimilated so much data that their nervous system had hit kind of a certain level of understanding and mastery of something, that they just kind of knew how things were going to go. They had assimilated so much data that they could just internally recognize patterns in whatever it is they were doing. So if they had spent 10,000 hours playing pool, it's a pretty good chance they're going to be a heck of a pool player. If they had spent 10,000 hours playing piano, it's a pretty good chance they're going to be a good piano player. And so I recommend getting some chart time in, but that doesn't necessarily mean trading. When I was going through that chart time development thing, I would actually spend time watching the charts and watching price action. I was watching both the charts, and I was actually watching the numbers of the actual prices on my trading platform. Why was I doing that? Why was I not sitting there looking for trades and trying to make trades and go from there? Why wasn't I, if I want to be a good golfer, why wasn't I just swinging the golf club? Well, let me ask you this. to be a professional golfer, do you think all a golfer does is swing a golf club? No, he doesn't. Do you think a baseball player, to become a very successful hitter, do you think all he does is swing a baseball bat and hit a ball? No, he doesn't. He actually goes through other exercises that help to train them to be successful, because if you train all these different exercises, they give you this collective experience which will allow you to be good at whatever it is you're trying to do. And so I would actually spend time just watching price, watching charts, absorbing the information, see if I can pick out the patterns. Sometimes I would just be watching the actual numbers as they moved up and down to see if I could spot patterns in how price moved, pure price. Believe it or not, before computers and charts, there actually was trading. And people used to trade just looking at the pure numbers of price and then making decisions based off that. Jesse Livermore was one of those. Probably one of the most successful traders ever in history. And so I would actually just look at price and study that, and eventually I hit my 10,000 hours, and all of a sudden the market wasn't so complicated anymore. You know, I could just look at the market and be like, wow, this is where the market reverses. And then next thing you know, the market starts reversing. Sometimes it would be, hey, it's because of this pattern, or sometimes it would just be, wow, I've seen this before. This is where the market reverses. If you've seen something happen 50, 100, 200, 1,000, or 5,000 times, whether you can intellectually recognize it or not, whether you can actually understand and name the pattern that is available in front of you or not, you still have the understanding. It's still in that brain there, in that nervous system that has assimilated that 10,000 hours of data that will say, hey, guess what? You've seen this before. This is where the market reverses. And then the market does. So that is what I would recommend. Now, a lot of you are thinking, well, shit, 10,000 hours, that's a lot of time. And you're right. There's only 168 hours in a week. When did I actually start to do this exercise? I started to look at this exercise years ago. And what I did was, this thing's not going to bring my calculator. I said, well, wait a minute. How many hours have I got now? And I had estimated I was at about 3,000 or 4,000 when I had come across this. And then what did I do? I said, well, let's take the remaining 6,000 and let's pick an average number of hours per week I think I would spend in front of the chart. And then I said to myself, oh, okay, I'll be there in 4 years. And many of you are thinking, 4 years? I'm sure many of you are thinking, shit, 4 years? I don't want to wait 4 years to be profitable. I don't want to wait 10,000 hours or that long to be profitable. And you know what? That's understandable. But let me ask you this. How many people you know become a concert pianist inside 4 years? How many people you know become professional basketball players or football players or Olympic athletes inside 4 years? How many people do you know that become professionals at anything inside 4 years? Even Bobby Fischer, who is just an absolute genius in his field. He'd been playing chess since he was in his 5 or 6, and he didn't hit a certain level of mastery until he was 13 or 14. About 10 years later. Find me someone on the planet who became a master at anything inside 4 years. And then compare them to the number of other masters across all fields and how many of them had done that inside 4 years. In reality, it's natural to say, oh shit, I don't want to wait 4 years. I'm sure FX3's not liking my language here, but I'm trying to get a point across. Hopefully I'm using it gracefully enough. Many of you are probably thinking, I want money now, I want bills to pay. Who doesn't want money now? Who doesn't have bills to pay? Technically, I don't have any bills to pay. I'm out of debt, but that's okay. But bottom line is, who doesn't want money now? It's actually built into our reptilian. There's a reptilian part of our brain. There's a part of our brain that's actually the same structure as it was and design as it was with the reptiles that looks for gratification now, and that we as a species are biologically programmed to put more emphasis on the results now and the benefits now than we will 2 weeks or a month or 4 years down the line. If I was to come up to you and say, hey, I'll give you a free massage if you spend 30 minutes writing down something for me, but you won't get the massage for 2 weeks from now. And then if I said, hey, guess what? I'll give you a 15-minute massage or a 20-minute massage if you spend 45 minutes right now. Most people say, you know what, I'd rather have the immediate benefit now than have to wait 2 weeks for something that's double or triple or quadruple the reward. Everybody wants that. It's actually a biological thing inside your brain. But what am I trying to get at here is that if you really think that you are going to become a professional trader inside a year, I have two things to say to you. Good luck, and you know what? I hope I'm wrong. I know of nobody that became a professional trader inside a year. If that is really intimidating to you, if you are in this market because of the riches and the glamour and the money that you could have and the chance that you could just be, have all the money you need and things like that, that's not somebody who really wants to trade, in my opinion. That's just desire. Almost everybody has that desire. But that's not the building blocks of what makes a master at anything or professional at anything. That's just desire. What will make you someone who is a professional trader is that someone who is willing to put in the work, the thousands of hours it will take to become that good at something, to learn all it is that you need to know, whether it's easy, whether it's hard, whether you have money or whether you're broke and living in a crack house. Because you know what? That's almost the exact history of my story. I was at one point completely broke in my life when I went through a dry spell in trading. And the person that was in the room next to me, in the building, it was like a townhouse thing, was actually somebody who was dealing drugs and crack. And I had to listen to them, and I'm sitting there going, this is unbelievable. I'm sitting there going, this is my life. I can't believe I'm going through this. I can't believe I'm in this hell. I was once successful in trading, and now I'm in the freaking dumps. And why did I keep going? It wasn't because I had some desire to be rich and things like that. I did it because I believed in my being 110% I can do this. It's easy to believe that when things go well. When the world is absolutely crumbling in on top of you, you have no money to your name, zero. You're living off of a bag of Doritos a day, and you sit there and say, I'm going to keep going forth. That's not desire. That's 100% belief in what you are doing. And so, if you are someone who's thinking, next 3 months, 6 months, 9 months, I'm going to do it, I'm going to be a professional trader, I'm going to be rich and make all this money, things like that, good luck, and I hope you prove me wrong. Rarely ever will that happen in any field, including currency trading. So, that's my answer to your question there, Gino. If you're not a profitable trader, spend as much time in front of it until you've assimilated so much information that you just know what the market's going to do. Doesn't mean you won't make mistakes, but you'll be able to recognize patterns at an unbelievable rate. And that's all trading really is discipline and pattern recognition. What do you think a system is? What do you think an actual trading system is? An actual trading system is somebody who recognized a pattern in the market. And that's all you're trying to do, is find a pattern and exploit that pattern. So that's my answer to your question. Okay, I want to breeze through a bunch of these questions, and I want to start looking at sterling dollar. Tim says, so SSTH, like role reversal areas, are not important to your trading as well. I like role reversal areas. I think they're great. I think used in the right environments, role reversal areas are excellent. When is the best time to use a role reversal? When the market has broken through a particular support or resistance with vigor and then comes back and retests that particular support or resistance level, and it treats it with not vigor, but it treats it with passivity, and it sits on the other side of it, well, then the price action is communicating that the institutional market used to consider this one support, now is considering resistance. Those are the best times to really use role reversal, when a support or resistance was broken with massive force. So I hope that answers your question. Boyke says, what do you think of pivots? I think pivots are excellent. I think it's something you're going to want to learn how to use, especially if you're day trading. If you are holding trades for a few days, pivot points probably won't be that useful to you. But if you're doing any sort of day trading, you will want to learn how to use pivot points. I've done the statistics on them. I've done 10 years of quantitative analysis on pivot points, and everything points to their importance and validity in this market. Schubert says, cybernetics, you mean? I have no idea what you're talking about there. William says, like an athlete doing fundamental drills? Absolutely. You know, Larry Bird, one of the best players, a basketball Hall of Famer, that guy used to do thousands and thousands of free throws every single week. Even though he was one of the most accurate free throw shooters out there in his time, he still did thousands and thousands of free throws. Why? Because the fundamentals and the basics that will make you successful will always be present. In fact, what is a guitar player? I met this guy who's this amazing guitar player. And he says one of the things he spends doing most of his time, he spent a lot of time doing scales. Just some of the basic things. Basic chords. I do archery. I met this woman who from 70 meters can hit a target 85% of the time that is the size of a silver dollar coin, which is not a big target. She can hit that with 85% accuracy from 70 meters. Does she spend all her time shooting from 70 meters? No. She spends about 80% of her time shooting from 3 meters. Because it's not hitting the target that's the most important thing in archery. The most important thing in archery is being able to repeat a particular posture and movement so that when you release the arrow, your body releases it with absolute precision. If you do that correctly, you will hit the target consistently. But it doesn't matter how good you are at spotting the target if you cannot move your body and release the arrow with absolute precision. She's an Olympic archer, and she spends most of her time shooting from 3 meters. She does about 400 arrows a day from 3 meters, and only does about 50 from either 18, 30, or 70 meters. So hopefully answers your question there. Jez says, where are you doing any other jobs when you were learning? Yes. In the beginning I was. I was once a yoga teacher for 7 years, so I was doing that for a little bit. And I was, at one point, working for a currency broker. So yes. PLIU says, how long did it take you before you became consistently profitable? My first 6 months of trading, I was consistently profitable, and then I went on a losing streak for a little bit. Then I had a year of about a winning streak. Well, not winning streak. I did a year of winnings. And then I had another 2 years of losing streak. And then after that, I had gone on a kind of, after that I had gotten back up to winning, and then I was just consistently winning. You know, it varied, but I was still consistently winning. So it was a long road. Wasn't easy. Jez says, how does 10,000 hours compare to the just over 2 weeks Mr. Dennis who taught the turtles how to trade? You know why it was probably easier for Jez or for Mr. Dennis? Because Mr. Dennis didn't learn how to become professional in 2 weeks. He had spent thousands and thousands and thousands of hours doing that. And he took all that 10,000 hours that he had learned and piled it into a particular method that he was able to teach them. But the funny thing is, most of the turtle traders today actually aren't that successful anymore. Most of those people who came out and became profitable, most of them are not making money today. Juan Feliz says, how you started again without money? I got a job, put some money in the bank again, put some money in my trading account, and started again. Anyways, Abel says, did you learn price action by yourself? For the most part, yes. I read some other books on price action, but like I read Martin Pring, and I actually didn't read too much on candlesticks. I really just didn't like candlesticks. I thought they were kind of a waste of time. But I read the stuff that's out there that everybody knows about, flags and pennants and all these things, but they all felt like they were missing the point. They all felt like they were taking the movie on the screen to be the reality and weren't realizing that it was something else that was producing that movie on the screen. And so once I started to really understand how order flow had influenced the market, I had gone on a quest then to really spend the next few years understanding what kinds of order flow or flows would influence the market, cause this particular price action, cause this formation. Once I had understand really what price action was, that it was just a movie on the screen, it wasn't the reality, then I really started to study price action, and that was all done on my own. So hopefully answers your question. Fernando says, Chris, leverage, your use of it, how has that changed over time for you? It's been exactly the same. I'm still trading 100 to 1. Hasn't changed at all. Every now and then, I may do 50 to 1, but it's still 100 to 1. Schubert says, can we learn by ourselves? Is it okay to be alone during trading? You can learn by yourselves. You can do that. But nobody ever becomes a professional pilot or pool player or anything without learning from somebody else. So the time that you can learn by yourself is when you've amassed so much information that you already are successful that you can kind of teach yourself. Kind of like when you've graduated from, architecture school and you've built enough buildings on your own and those buildings haven't collapsed. In fact, they've worked out just fine. Once you've had enough experience on your own, then you can kind of learn from yourself. But you still have to build that base of knowledge. You still have to build that foundation. That's why I recommend finding a course or a mentor, something like that, that you really gravitate to. Particularly a teacher that you really gravitate to, that when they talk, what they say makes sense to you. You're like, oh wow, that totally makes sense. Oh wow, that's intuitive. Oh yeah, I see what he's saying. When you find a teacher like that, then stick with that teacher. Learn everything you can from them. That's my thoughts on that, Schubert. PLI says, do you carry trade? How long do you hold on trades on average? I used to carry trade when the environment was really primed for it, aka the market was in a particular increasing interest rate cycle, and that was something that was going on for years. But since then, most carry trades has ended up not working out. In fact, I forget the book I was reading, but it was something by an institutional trader. It was a hedge fund trader. And his quote was, "Has anybody in here had a carry trade that didn't end up bad?" And nobody could say anything. And so I think carry trades are good in the right particular environment, but in an environment of so much turbulence and, chaoticness and uncertainty, I don't think carry trades are a good idea. They're usually good in stability when, there's a clear difference in the differential yields between two countries, and that's likely to continue for a long period of time. Other than that, I don't recommend carry trades. How long do I hold trades? Depends on the particular system. I have some systems that get me out 15 minutes to maybe an hour. I have some trades that'll keep me in them for days. Depends on the particular system. Okay, last two comments, and then we're going to take a look at sterling. Try does it. It says, it's also typical for achievers that they love what they do. People who study engineering medicine just to earn more money, they statistically have a lower chance of succeeding. More of them break up their studies than people who love the topic. You know what? That's absolutely true. Because the bottom line is that, to become a doctor, you have to go through a massive amount of work and study and things like that, and your resolve is going to be tested. Do you really want to do this? And eventually that question will come to the surface and will be boiling over, that you'll either have to go numb to the truth, or you'll have to accept the truth that you really don't want to do it. And so the most important thing that somebody can do is totally love what you do. Totally believe in it 110%, so that every breath in your being is all dedicated towards one effort. That's how I was able to do it when I was living off of a bag of Doritos a day. And we're not talking the big bag, we're talking the small bag. There was a point in my life where I was that broke. And yet I still kept studying and practiced trading because I believed in it 110%. I had no idea why I believed in it. I just did. And I just felt like this is something I have to do. This is something that I absolutely believe I can do. You have to love what you do. Otherwise, if you don't, it's just desire, and when stuff gets really tough, you'll fade. You will break. So, hope answers your question. Last question, Chris. Have you read the book by Thomas? Have I read Thomas Bulkowski? Yes, Encyclopedia of Candlestick Charts. In fact, that's one of his book is actually one of the main reasons which confirmed my theory about candlesticks, that they're not really that useful. Why? Because he took over how many patterns, how many hundreds of candlestick patterns, and only found 7 that worked? I consider that a failed science when you produce 100 theories that you assume are truths, and that you find that only 7 are actually have any validity to them. So, but that's my thought on that. Okay, what I want to talk about on sterling dollar today, in terms of structure. So we're going to talk about structure, and then what it communicates about order flow. The structure that I want to talk about is angles of price action. Very few people spend time studying the angles of price action. The thing about it is that the angles of price action can actually communicate a lot of information about where the bias is. One of the best ways to measure the angle of price action is that you draw a particular on retracements or pullbacks of some sort. Let's take a look at this particular move here. How do you draw an angle of price action? You have to find kind of like a general trend line within that particular price action. It's not going to be perfect. It's not going to be an exact science. You're just doing the best you can. So you're finding a stable trend line for that particular price action. It doesn't have to be on the bottom side for an uptrend or the top side for a downtrend. It just has to be one stable side that you're measuring the angle. And what you're doing is really trying to gauge which one has the sharper angle of the two. Generally, the one that has the sharper angle is the one that's likely to push price action in that direction after the pullback or retracement continues. Why is that? What does angle tell you about price action? Angle communicates the strength or weakness of the buying and selling. If the buying and selling of the price action is incredibly sharp, the only way that is physically possible to create that kind of angle on a chart is by an immense amount of buying and or selling pressure, depending on the direction. Massive amounts. If we were to look at the order flow as a spectrum, and the left side is all the way to the left side of the spectrum is 100% selling, and all the way to the right side is 100% buying. Well, when the market's flat or barely angled, well, then the compass of that spectrum will be right in the middle. But as that compass or needle moves further and further to the left, that will increase the angle of the selling. Or if the compass moves further and further to the right, that will increase the angle and the price action of the buying. So the angle communicates the strength of the buying or selling pressure. Now, this was a really good example as I was looking at this one here. This one actually produced a buy signal on one of my other systems, but because I'm such a price action junkie, I said, I just want to take a look at the price action real quick and check something. So I measured, I said, hey, we have a little buy up and then pull back, and I wanted to measure the angle of the two and see which one's stronger. So I measured the angle. At first glance, it looked like the buying was stronger than the selling. Then what I did is I just connected the two lines together, and I said, which one is the sharper angle between the two? And I looked at that and said, the buying is the sharper angle. Thus, the order flow that was part of the buying, to me, had communicated that it had more strength as a whole than it was the selling. And so, as markets move in a direction and they pull back, usually the angle of that pullback will communicate whether that pullback is likely to make a deep pullback or reversal, or it's just a retracement that's a part of a trend that's going to continue. And when the retracement is at a much baser angle, it usually means the market's likely going to continue. So my system was about to give me a signal, and I just said, I just want to double check the price action on this real quick, just to confirm the strength of this signal. And the angle on the pullback was weaker than the buy up, so I said, that's it. I'm taking this signal once it comes. Signal came, I took it, and that was it. And off the market went. Did I expect the market to go for this far of a run? No, I didn't expect it to go for any amount in particular. I just traded my system. My trade system said take profit here, let the trade run until it gives you an exit, and it gave me an exit once this little pullback happened, and that was it. So I caught a decent share of the move. So measuring angles is a very, very powerful thing because it will be communicating to you the strength or weakness of the order flow behind that particular move. Does that answer your question? Or does that give you guys a good idea of how important angle is? Yes, no? Some idea? One person, yes. Okay. I guess we can say that's sufficient. Now, what time frames does this work on? And what time frames would I recommend it? In reality, the principles, and I'm saying principles, I'm not saying systems. In reality, the principles that underpin the price action on a 4-hour chart are the same ones that underpin the price action on a 1-hour chart or a 1 minute. So if the angle on a 4-hour chart is strong to the upside, it's also going to communicate the same thing as it would if the angle was strong on the 1 hour. That the price action was strong in that particular direction to create that market movement. However, that doesn't mean that I will trade my systems on any time frame. I trade my systems on the very specific time frames they are tailored for. What would I recommend using this concept of angle to really feel like you can feel comfortable with the information you're getting from it? I would say at the minimum 1 hour time frame, because then you'll have a fair amount of data to have some validity. And in some sense, trading, you really have to be like a scientist in many ways. Not all scientists, just some scientists. And so, with that being said, you want to have a lot of data. The more data you have, the clearer your answer will be. The more poker hands one of my opponents has, the more his statistics will converge, and I can use those statistics against him. So we have to be scientists, and that's why I'd say 1 hour time frame would be the lowest time frame I would consider doing it. 4 hours in dailies, fantastic. I do almost all my trading off the 4 hours in dailies charts. That doesn't mean I'm in positions for days and days and days and days on end. Majority of my trades are done within the same day or within a couple of days. So that's where I would suggest it. Greg says, Chris, the angle of the latest move up is steeper than the previous move up. Does that indicate it may be topping out? I have two questions for you in response to your question, Greg. A, are you short or planning on shorting it? B, why would that indicate it's topping out? So maybe you can answer the first question. Are you short or planning on going short on the sterling dollar? Just curious. While you're answering that, I'm going to answer Abel's question. A, looking for an out, not shorting. You're looking for an out? Are you looking for an out? An out. It sounds like a poker move. Looking for an out. You're not shorting. Are you already short? Is that what it is? So you're already short and you're looking to close. I had the feeling that that's why you're asking that question. This is a classic example of a trader being in a trade that's going against them and looking for something to confirm their reality that they think is true. Instead of listening to the market and what it's communicating. You're long. Oh, okay. Okay, great. All right. Good. Well then, fantastic. I take all that back. Good. You want to be on the long side. Why would the sharpness of the angle indicate that something topping out? The fact that let me explain this to you in this way. The market had a pullback, it had a decent pullback, more base of a pullback, and then it just launched to the upside. And we're talking 1, 2, 3, 4, 5, 6, 7. 9 candles in a row, 9 hours of straight buying, 200 pips later. So after 9 hours, the thing launched 200 pips, and the market was launching up in that time frame very aggressively. That communicates an immense amount of order flow behind that particular order. The market has a little bit of a pullback here, which actually is a roll reversal level, if I'm correct. And then what does it do? It starts to launch up again. Now, if these launch ups, these particular breakouts of the previous resistance had gotten smaller, I would be a little bit more concerned about it. But this last candle got longer, suggesting that there was a new round of buying. And not just a new round of buying, a lot more buying. So to me, that communicates that there is still strength in this particular move. Then on top of it, to top this last part off, take a look what happens. We run into some sort of resistance level or pullback. The market spends 1, 2, 3, 4, 5 hours pulling back, but yet the 5 hours of selling doesn't even eat into more than, 60% of the body? So business A, which is on the long side, makes, 100 pips in an hour. Business B spends 5 hours only making 60 pips. Which business do you feel more comfortable investing in? Hopefully business A. And how does the market respond? The buyers say, they see this kind of selling and they say, That's nothing. You guys are weak. You don't got anything. We're going to buy this again. And that's what they buy it with force and aggression. So to me, the price action is communicating that there's still strength in this move. Do you see that? This particular section right here? Do you see that? Hopefully it answers your question. Okay. Last question here from Abel, and then that's it. The angles all look A and T the same. Can you demonstrate the principle again? Okay, I'll do this again, but the angles are definitely not the same. Here's the move I was talking about before. You find a consistent stability or trend line within the price action. The two moves, the top side and the bottom side. Take a look at this. If you look at the angle, just looking at the pure price action, this looks more like a base of an angle, and this looks like a sharper angle. But if you want to find out for sure, you just take the two lines and you put them on top of each other like this, connect them at a particular point, and then figure out which one has a sharper angle. And it's subtle, but it's this one. This one has a sharper angle. It's just a little bit stronger than the other. So it communicates to me that the buying is slightly stronger than the selling. That's all you're really doing. This angle is the sharpest. If I was to, that's way sharper than all of them. So hopefully that makes sense there, Abel. Okay, fantastic. So I got to get going. End of the class. So I want to say, first of all, thank you all very much for coming. Have any questions about what we do? What I do? Price action trading? SecondSkiesForex.com. Any questions? I always love to hear from you. Email me, info@secondskies.com. Until then, I bid you all adieu. Good luck trading. I'll see you guys next week. Take care, everyone.